Every single day, forces you've never heard of are moving your money. The Fed, AI, geopolitics, currency wars. Most people only see the headlines, but they never understand the signal beneath the noise. That's what MacroSignal is for. And in this explainer, we are going to decode exactly what is happening in the global economy right now.
Yesterday, something happened in Geneva, Switzerland that moved every major stock market in the world simultaneously. Hong Kong, New York, London, all higher in the exact same session. The US and China just agreed to slash their tariffs from 145% all the way down to 30%. Markets called it a massive breakthrough. But here is the question nobody in the financial media is actually asking. Is this a genuine turning point, or is it a 90-day truce in a war that is structurally far from over? Because the answer to that question will determine whether you should be repositioning your portfolio right now, or whether this entire rally is actually a trap. We're going to break down the explosive data behind this trade truce and map out exactly how to navigate it.
Section 1. The 90-day trade truce. When US and Chinese officials finally concluded their intense two-day meeting in Geneva to address these spiraling trade tensions, the global reaction was absolutely staggering. On the news of a breakthrough, the Dow Jones surged over 1,000 points right before the trading opened in New York. The tech-heavy NASDAQ jumped 4%, and the S&P 500 spiked 3.2%. I mean, investors were clearly starved for any sign of relief after months of escalating uncertainty. But what exactly triggered this massive wave of optimism? Think about the sheer scale of the tariff reduction we just witnessed. U.S. Treasury Secretary Scott Bessent and Chinese Vice Premier He Lufeng brokered a deal to slash reciprocal tariffs by up to 115 percentage points. Let that sink in. Prior to Geneva, U.S. tariffs on Chinese imports sat at a staggering 145%, while Beijing's retaliatory tariffs were at 125%. Now, under this new 90-day truce, the U.S. effective rate drops all the way down to roughly 30%, while China reduces its levies on American imports to just 10%. That is a massive overnight injection of economic relief into the global supply chain.
But here's where we really need to separate the headline from the signal. The headline screams peace, lower taxes. The signal, however, suggests this is merely a tactical pause. We have to ask ourselves as retail investors, are we looking at a permanent de-escalation here? Or is this simply a deep breath in the middle of a structural decoupling between two superpowers? To answer that, we have to examine just how bad things got before they were forced to the negotiating table. Section 2. Anatomy of an embargo. Words really matter, especially in macroeconomics. An embargo is an official ban on trade. And while we officially called this whole thing a tariff war, U.S. Treasury officials themselves admitted that the prior 145% tariff rate functioned not as a standard tax designed to protect domestic industry, but as a functional embargo. Actually, Secretary Bessent flat out told reporters in Geneva that neither side actually wants an embargo. Yet somehow, that is exactly what they accidentally created. So the absolutely crucial point here is the burden this placed on everyday people. Before this 90-day truce was signed, Americans faced an overall effective tariff rate of 17.8%. According to the Yale Budget Lab, that is literally the highest tariff burden placed on consumers since 1934. That means higher inflation, much tighter margins for businesses, and a tremendous drag on your everyday consumer spending power. How on earth did we get to 1934 levels so quickly? Well, consider the timeline. In early April 2025, a rapid-fire series of U.S. executive orders, specifically 14257, 14259, and 14266, were signed in a matter of days. A gap of practically nothing between April 2nd and April 9th triggered immediate heavy retaliation from Beijing. You know, this wasn't some slow, predictable buildup. It was an abrupt freeze of global trade routes. The sheer speed of this escalation is exactly why markets were caught completely off guard and why the economic fallout was so incredibly severe. And man, the macroeconomic fallout was catastrophic. Trans-Pacific container traffic dropped by 30%. Major global shipping giants like Hapag-Lloyd and Kuhn-Klunz-Nagel were forced to drastically reduce their key routes. Oxford Economics even estimated that under those policies, the U.S. faced a 1.4% annual loss in GDP. To put that into perspective, that's a $300 billion hit to the economy. The global trade superhighway was effectively shutting down. Now, all of this volatility heavily distorts the official data. If we look at the Federal Reserve Economic Data, or FRED, we can see how wildly U.S. exports to China swung. They dropped heavily during the peak tensions before showing some recovery signs, bouncing back to $11.1 billion as back channels opened up, all while the nominal broad US dollar index hovered around 118.39. This kind of volatility visibly rocks the US trade balance. When export volumes collapse like that, it strains currency strength and creates a highly unpredictable environment for the multinational corporations sitting right now in your portfolio.
Section 3. The Tech and Supply War. Zooming out from those shipping containers for a second, we find the real 21st century battleground, the war for technological dominance. Let's compare the core strategies here. The US has utilized heavy export controls on advanced semiconductors while pouring money into domestic production through the $52 billion CHIPS Act. But here is the unintended consequence. These bans have radically accelerated China's pivot towards self-reliance. Beijing just poured $150 billion into domestic chip production. And Chinese startups like DeepSeek, they're now reportedly producing AI models that rival US giants at 30 to 40% lower costs. The embargo didn't stop innovation, it just bifurcated it into two completely separate ecosystems. And Beijing holds a massive trump card: rare earths. Part of this new Geneva agreement involves China easing non-tariff barriers, specifically resuming the export of rare earths to US customers. These materials are absolutely critical. You literally cannot manufacture US computer chips or electric vehicle batteries without them. This is the underlying geopolitical leverage. The US might hold the advanced semiconductor designs, but China controls the raw materials required to actually build the thing.
Section 4. Geopolitics meets the portfolio.
So how do these abstract government policies actually affect your wealth? Well, to understand the risk, we have to look at history. In 1941, a severe US oil embargo on Japan preceded the attack on Pearl Harbor. Now, obviously, no one is predicting a hot war tomorrow. But this is a really sobering cautionary parallel that is frequently discussed by geopolitical analysts right now. Severe economic restrictions, blockades, and embargoes can inadvertently spark strategic miscalculations. When you cut off a nation's economic oxygen, the volatility moves from the stock market to the real world very, very quickly. And yet, here is the ultimate paradox of this whole decoupling idea. Despite all the tariffs, the heated rhetoric, and the bans, China still provides 13.5% of all US imports. Furthermore, Beijing currently holds $760 billion in US treasuries. They are fundamentally intertwined. Absolute 100% separation right now would be economically devastating for both sides. And you know what? That is exactly why they rushed to Geneva for a 90-day truce. They hit the pain threshold of decoupling.
Section 5. How to reposition now. So what do we actually do with all this information? Let's lay out a practical framework for your investments given this deeply fractured global reality. First, diversify supply chains. Look for companies that are actively building alternatives to Chinese manufacturing. For example, apparel companies like PVH Corp that are highly focused on Vietnam. Second, bet on tech leverage. Advanced semiconductor equipment firms like ASML or highly cost-efficient AI developers like Alphabet's DeepMind, they're positioned to thrive because both sides of the decoupling world need their underlying technology. Third, monitor geopolitical catalysts. You need to watch the WTO dispute mechanisms and the next round of these US-China trade talks closely. Those are going to be your primary triggers for market volatility over the next 3 months.
I want to leave you with this final provocative thought. The market is out there celebrating a 90-day pause, but the underlying supply chains, the AI arms race, the battle for rare earths, none of that has stopped. So ask yourself, is your portfolio built for a temporary 90-day truce, or is it fundamentally prepared for a decade of structural decoupling?